All right. Let's see. Okay, we're starting. Let's see if anybody's piling in. And just to
Coming in
test,
hot.
Lewis, can you see the PowerPoint?
Yes, I can.
Okay, cool.
Yeah,
Um,
perfect.
well, right on. Welcome, people. Thanks for coming and thanks for joining in. I appreciate it. I see the numbers are going up. We'll give it a couple minutes for people to file in, and then we'll start shortly. Um, Thank you, Justin. Yeah, in the meantime, if anybody wants to shoot in the chat where they're coming in from, that's always a good time. For context, I'm in San Diego, and Lewis, where are you based out of, if you want to share?
Yeah, I'm in Pasadena, California.
Another beautiful place. The two SoCal people here, so that's always good. I think you're probably having a little bit better weather than I am. San Francisco, thank you, Henry. I just came back from there a couple of days ago. San Jose, very cool. Let's see, do we have any
California
East?
is hard today. It's
Yeah. Lorenzo, nice. Oh man, these really are middle of nowhere, California. Do we have any East Coast people? Any Midwest? Any DC? Seattle? Very nice. Cool. We'll give it another couple minutes. I just want to say I'm really thankful for everybody to join. This is going to be a fun time. We're going to cover a lot. This is a really interesting topic and something that's obviously very near and dear to both me and Lewis's hearts. This is also a bit more specialized webinar than ones that we've done in the past. Obviously, we've had very broad ones talking about real estate in general. We've had some that talked about just like insurance, and this one's obviously focused on taxes. So thank you all for joining. We'll just give it another minute as people file in. I still see the number kind of shooting up. And then we will get started.
Yeah, I'm from New York originally. I don't see any East Coasters.
Last time, a couple of times ago, we had a couple of people from where I grew up in DC. But yeah, that's right. 2 East Coast transplants here. Okay, well, we can get started. I do see the numbers still going up, but people will come in and then obviously they'll catch up and we'll do a little bit of an introduction. So yeah, Lewis, this is awesome. Thank you so much for joining. Thanks to everybody else who's joining on the webinar. As I mentioned, today we're covering taxes and real estate investing, and I'm joined by Luis Rosa, certified financial planner, enrolled agent. He's the founder of Build a Better Financial Future, which is a financial planning firm targeted to help Generation X build their financial future, as well as Latinx internships. This is an awesome company that places aspiring Black and Latinx financial planners into paid internships. He was also the host of On My Way to Wealth podcast. He's named one of the Investment News' 40 Under 40, Financial Advisor Magazine's 10 Young Advisors to Watch, and Investopedia's Top 100 Financial Advisors. So today, Lewis and I will be chatting through a variety of topics related to real estate tax. We'll discuss why real estate is so beneficial with regard to taxes, what exactly is deductible, how do you do it, and why the IRS in general has made real estate so great from a tax perspective. Lewis will share some of the insights he has in the real estate and tax world from what he sees on a day-to-day basis, advising clients and helping people navigate the world of financial planning. So with that said, I'll pass it over to you, Lewis, if you want to give a short introduction about yourself and how you came to be doing what you're doing.
Yeah, thank you very much, James and Justin and the Dorvest team. Also, thank you all for attending. I appreciate the fact that you're taking time to educate yourselves and hopefully gain some knowledge today that will help you make some informed decisions in the future. So I am the founder of Build a Better Financial Future. It's a fee-only financial planning firm. I help my clients with taxes, investments, and planning in general. Things like understanding their employee benefits, stock options, their life insurance needs, and things like buying real estate, for example. I grew up in Dominican Republic. It's a small island in the Caribbean. I moved to New York when I was 11, and then I had to learn English when I moved to the US. Lived most of my adult life in New York, then moved to Las Vegas for about 5 years, and now I'm in Pasadena, finally made it all the way out west. And the reason I launched my firm was because throughout my 20-year trajectory in the financial planning industry, I noticed a big gap in the people that needed to be served. I noticed that the traditional financial planning or investment management industry is usually revolved around working with individuals that already have accumulated a large amount of money to invest. So what I noticed was that the people that were of my age or younger were missing out on the advice that they need because they didn't have large sums of money just yet. They might have just graduated college, starting families, saving money in their 401ks, which is not something that a traditional investment firm could manage. So they were just missing out. They were just like no access to a certified financial planner professional. So I just went out and launched my own firm to work with people on a fee only basis. And all that means is that I don't sell any products. So there's no commission involved in the way my business is operated. The clients pay me directly either to manage their money or to give them my advice. So I'm excited to be here. So thank you very much for the opportunity. And I look forward to answering the questions at the end as well. Thank you, James.
That's, of course, that's an awesome background, seriously powerful, and always welcome people on with experiences like that, and yourself being a serial entrepreneur. It's really interesting, and I'm looking forward to getting started. So let's do it. Real estate obviously is a very interesting asset class because you can realize gains in income, meaning the home appreciation and the cash flow you get from rental income. On top of that, there's a number of deductions you can take. Can you walk us through the deductions and the taxes around real estate more broadly? What are they? Why are they helpful? And any other insights that you want to share?
I like the way that you frame that, James. In fact, real estate is a very unique asset because there are several different ways of making money. First of all, if you have a rental property, the most obvious one is you make rental income. The second thing is that traditionally the value of the property will go up over time. When you look at it historically in the United States, the average median home price in 1951 was slightly over 18,000, and in 2021 is above $314,000. So obviously there's ups and downs in every type of market, but traditionally over time, real estate values tend to go up. So that's another way of making money. And third is the tax advantages that you can have while you own the asset. Some of the things that you can deduct. I want to, first of all, go back a little and just talk a little bit about what a deduction is. A lot of the times people hear the word deduction and they think that it's a dollar for dollar amount that you get back in your taxes, but that's not necessarily the case. All that it is money that you do not pay taxes on. So to give you an example, if you had, let's say you were in the 22% tax bracket. In the United States, there are 7 tax brackets currently. Not all of your money gets taxed at once. It gets taxed at different phases as you go up and make more money. But let's say somebody happens to fall in the 22% bracket and they had a $10,000 deduction. That means that they will not pay taxes on that $10,000. So in essence, they would save 22% of 10,000, which in this case would be 2,200. So it's still a tax savings, but it's not a dollar for dollar savings. So I just wanted to clarify that for those folks that may not be aware of what a deduction really means. A lot of the times you might participate in deductions even outside of your tax returns. So some of you that may put money into your 401k, for example, the money that you put into your 401k as a pre-tax dollar amount doesn't get taxed today. So you will notice that your wages in box 1 of your W-2 is lower than boxes 3 or 5 because the amount that you contributed to your 401k is not being taxed. So in essence, you're getting that deduction. You're saving yourself some money as a result. So when you own a primary residence, you typically don't have too many deductions that you can take. So one of the most traditional things you can deduct is your mortgage interest. And I'm going to talk about itemized deductions versus standard deductions. The IRS lets you take money off of your adjusted gross income before you arrive at your taxable income. So you have 2 options. One is to take a standard deduction, which is basically an amount that the IRS gives you based on your filing bracket. So to give you an example, somebody that is single can take a standard deduction of $12,400 in the year 2020. And in 2021, that has gone up to $12,550. Married filing couples are $25,100. So let's say you don't own a home, you don't have charity, anything like that. You're just a basic tax return W-2 employee. As a married couple, you can take off $25,100 off of your income. So say you made $100,000 combined and the standard deduction is $25,100. You now only made $75,000 in terms of your taxable income, which is great. Now, some people are able to deduct even more than the standard deduction because they have other things like mortgage interest, property taxes, state and local tax, which they call SALT, and that is capped at $10,000. But even so, some people between their state and local taxes plus mortgage interest, charitable contributions, any medical deductions above 7.5% of your adjusted gross income can also be considered an itemized deduction. Some people have more money than the standard. So you get to take whichever is highest and works better for you. So let's say in the same example, somebody's married filing jointly and they have $30,000 worth of deductions. They can take that number instead, and their taxable income is only 70,000 as opposed to 75,000 if they did the standard. So on the investment property side, there are many more deductions that you can take in addition to the property taxes of the property, in addition to the mortgage interest. When you have your mortgage, usually you would pay back every month and you pay in a portion of it is principal, a portion of it is interest. The interest can be deducted in what's called a Schedule E. When you file your tax return, if you own rental property, one of the schedules you need to file is a Schedule E, where you get to report your income, but then also you get to deduct your expenses. Mortgage interest, property taxes, the insurance to insure the house could be deducted as well. That's one thing that you cannot deduct in your primary residence. Also, if you pay any commissions to like a property manager, any legal fees, you can deduct those. Homeowner association fees. If you're responsible as a landlord for any utilities for common areas, so water and anything else like electric, things like that, you get to deduct. Any repairs that you do throughout the year, you get to deduct those as well. Quick note about repairs. One of the most common mistakes that I see, sometimes people confuse repairs versus improvements. Repairs and improvements are deducted differently. So if it's a repair, like you fixed a hole in the wall, or you had to change a lock, something like that, you can deduct that the year of. If it's something major like heating, ventilation, air conditioning, or like installed a new roof, that gets to be depreciated over time. So you get to deduct a portion of that over time frame. So there are a lot of different deductions that you can take on a rental property. And one of the benefits is that you might end up being in a situation where you have a loss on paper on your tax return, but you had actual profit in real life. And one thing that plays a major role in that is depreciation. When you have a rental property, you get to deduct a certain amount in depreciation as if the property was going down in value. So remember earlier, we were talking about the benefits of real estate going up. So in real life, your property might actually be going up in value. For tax purposes, your property may be going down in value. And the way the IRS looks at it is you get to take the value of the property minus the land, because the land does not depreciate. And then you divide that by 27.5 years. And that's the amount that you get to deduct as an expense on your Schedule E. So your Schedule E, you list your overall gross income and then deduct all your expenses, including depreciation. And you might be in a situation where you end up with a loss. Now, the advantage of that loss is you get to then write off some of that losses depending on your income. If you make less than $100,000, you can deduct up to $25,000 per year from your other income if you have a paper loss from your property. If you make between 100 and 150,000, you get to deduct a portion. And if you make above 150,000, you do not get to deduct it. However, because you have a loss, you're not paying any taxes on your rental income, and that loss gets to be carried forward as what they call a suspended loss for future tax years. So if you happen to fall under the 100,000 in a certain tax year, like for example, during the pandemic, some people had less income than usual, they were able to take advantage of some losses, or when you sell the property as well. So I know that was a very long answer, James, so I apologize.
No, thank you for walking through that with so much detail and clarity. Going off of what you said about the suspended losses and carrying for that, and kind of on the flip side of the deductions, which you mentioned, whereas deductions are to rental income, the other side of the tax kind of game is obviously capital gains tax. So I think that's a good segue. Can you walk me through why it is? Is there any exceptions? Any insights that you want to talk to people on how this might differ from like your regular everyday rental income taxes?
Yes, I'm glad that you brought that up. So going back to primary residences, you cannot deduct certain things as much as you could on a rental. However, there is a benefit. So I wanted to mention that since we're talking about capital gains. On your primary residence, if you have a property that you lived 2 out of the past 5 years as a primary residence, a single person can have an exemption up to $250,000 in gain. A married couple that files jointly has an exemption up to $500,000 in gain without paying any taxes. So if you bought a property for $300,000, you lived in it for, say, 5 years, you sold it for $1 million, and you have a $700,000 gain, for example, the first $500,000 will not be taxable because you have that primary residence exclusion. So when you own a primary residence, it's not as advantageous during the tax year in terms of deductions, but there is a benefit at the end too. So that could be another strategy, in essence, where you could buy a primary residence, live in it 2 years, and then turn it into a rental, and then move and then just continue to do that, right? And take advantage of the tax code,
Yeah.
completely legal. So capital gains, basically, IRS has 7 different tax brackets for your personal income tax. However, for property, and property could be real estate, could be stocks, et cetera, there are 3 different rates that you can pay. One is 0%, which is great. The other one is 15%, and the other one is 20%. And that depends on your income level. So when you sell a property at a profit, if you have owned it for less than a year, it's considered a short-term capital gain. And short-term capital gain rates are the same as your ordinary income. So whatever income tax bracket you happen to fall on, that's the rate that you will pay on something that you've owned for less than a year. Now, if you own something for a year or more and you have a profit when you sell, then you have long-term capital gain rates. Right now, the max capital gains is 20%. So just to give you an example, let's say a single person right now that has taxable income of $40,400 or less will pay 0% in capital gains. And a married couple is just double that, $80,800. So that also provides for a great planning opportunity, because there might be years where you expect to make less money, and it might make sense to sell an appreciated asset that you've had, whether it's stocks or real estate, et cetera. So great reason why you should be working with somebody that is a professional that knows all these tax laws, et cetera. So they know what one hand is doing versus the other.
Very interesting. And that's what I like that you brought up. There's the IRS gives you so many different options and benefits. There's definitely a way to be strategic about all of it and kind of maximize your benefit. And kind of a good segue from that is something we get asked a lot about at the DoorVest side, our 1031 exchanges, as a way to defer capital gains tax. Can you walk me through just at a high level what this is, why it's so beneficial, why somebody might want to do it?
Absolutely. So that's another strategy where if you do have capital gains, the IRS under Section 1031 allows you to buy a like-kind property and in essence swap your property and defer the gain on that property. And you're basically just kicking the can down the road, but you're able to not pay the taxes on the sale. There are some timelines and rules that you need to follow. So you definitely need to be working with somebody that knows what they're doing, because there are specific timeframes for identifying the new property, and then you have a certain amount of time before you close on the next one. But if you do it right, you're in essence able to take the gain from one property, buy another one, and defer those capital gains onto a later date, perhaps when you sell the property that you recently bought.
Very, very interesting. And so with that, I would love to hear kind of your thoughts or how you help people try to think about single family versus multifamily homes. I know within real estate investing, there's a lot of deductions that are consistent between the two. I know that there's some that are different. If you could shed some light kind of on both of those and what you might typically recommend to somebody.
This is a single family versus multifamily?
Yeah.
Yeah, so the rules are basically the same. If you have like a single family or multifamily in terms of rental income, you would just file your Schedule C the same way, report the rent and deduct the expenses. Now, one thing that like back in New York, where I'm from, in the Bronx, it's very typical to have 2-family homes or 3-family homes, even 4 families. And what happens is very often I would have a client that would live in one of those units. So that's where it gets a little tricky, but the IRS in essence considers it from a tax perspective as if you have 2 separate properties. So if you are in that situation where you live in one of the units or plan on living in one of the units and then planning on renting the other half, you then have to make an allocation between your Schedule A, which is your itemized deductions, or your Schedule E, which is the rental property income. So let's say the size of the units was the exact same. To keep it simple, you would take half of the expenses in terms of property taxes and things like that, including the depreciation, and put that on your Schedule E. and then take the other half and use it as an itemized deduction, which may or may not add up to more than the standard, right? So yet another reason to work with a professional, right? Because then it gets a little complicated there.
Very interesting. It definitely shows there's some, again, room for strategy and kind of playing with what the IRS gives you. And actually with that, another question that we kind of commonly get is what are the benefits of, say, like an LLC? Can you give me the rundown on like the pros, the cons, what people should be thinking about if they want to consider putting their home into an LLC versus just, purchasing it under their own name?
Yeah, that's another great question. So an LLC, it stands for Limited Liability Corporation. And in essence, anyone can easily set one up. They're done at the state level. So wherever you happen to reside, you can open up an LLC. It's not that complicated. You can work with an attorney. Probably you should, because you have to establish an operating agreement and things like that. But in essence, the purpose of it is what the word says in the title, limited liability. So if you open up an LLC and then you buy a rental property in the name of the LLC, you are further shielding yourself from potential liability in the future. So to give you an example, let's say you live in a state that's cold like New York, and you have a rental property and it's snowing out and somebody goes by and slips and falls. If you own your property in your name, that person can sue you personally, right? Now, if you put the property in an LLC and the LLC is the owner of that property, the person would then sue the LLC, not you, right? So you create like a barrier between you and the company that owns that. It also helps protect your other assets. So another strategy that I've seen people do when they build a portfolio of real estate, where they end up going, it's a lot of hassle, right? So I'm going to talk about the cons, but they end up creating an individual LLC for each property that they own. So that way, each particular property is in fact in its own little bubble, and a lawsuit from one, for example, will not spill over to another property or even your own personal assets, right? So it could be a good strategy. Now, one of the cons is the financing. Typically, mortgage companies are going to be more restrictive in terms of the mortgage rate that you get when you go buy a property in an LLC name. They might require a bigger down payment as well. Also, if you already own the property and then you're trying to change the title into an LLC, that's going to cause you some headaches. You really should call the lender, because they might have their own rules. They might have a fee that you need to pay. Some of them might change the terms of the loan on you, because now you're transferring ownership. It may create some transfer taxes in your county as well, plus the paperwork. And the other thing is the expense as well of creating it. If you're going to pay an attorney to create it for you, then the expense of keeping the LLC open, you might have to hire the CPA at the end of the year to prepare the return for the corporation. And so you kind of have to do a cost benefit analysis, see if it makes sense for you to incorporate, do the LLC. Obviously, if you're going to do a portfolio of multiple properties, it might make sense from a financial standpoint, but something that you should definitely consider and speak to your CPA or your attorney about.
Got it. Very interesting. And thanks for kind of laying out the cost benefit analysis and what people should be mindful of and the different scenarios or situations where it might make more sense versus not. And then also, I guess, as a subject that I'm sure is near and dear to your heart, how would you kind of recommend people going about paying for their taxes? I think you've alluded to this in a couple of your answers previously, but should they consult a professional? Should they try to do it on their own? I guess what are your thoughts there?
Yeah, if you're just say a W-2 employee and you don't have any itemized deductions, you take the standard deduction every year, then it's fairly easy to do your tax return online with one of the major software vendors. Even if you have student loans, things like that, like those softwares are usually very good at asking you the right questions for you to get your tax return done. Now, when you start asking questions, you find yourself Googling things. I like to say when complexity starts is when you need to hire a professional, because the amount of money that you might save, it's going to be a lot more than the fee that you pay them. So for example, we were talking back about rental real estate. One of the big mistakes I see a lot of people do is the depreciation schedule. When they first place that property in service, a lot of people don't realize that you cannot take deduction for depreciation of the land, and they just put the entire value of the property. So they end up taking more depreciation than they should have. So that needs to be corrected, right? a professional would have known that from the beginning and set you up right away. Another mistake that I see as well is where people don't take depreciation just because they didn't know about it, and they're doing the taxes by themselves. Now that's another problem, because if you don't take depreciation, first of all, you're cheating yourself. But second of all, when you go sell the property, the IRS is still going to consider that depreciation, even if you didn't take it. So you might as well do it right from the beginning, right? So when you have those complexities, and those complexities could be outside of real estate as well. Like, I know a lot of clients that are starting to get stock options at their work, and now they have to figure out, hey, I'm getting these stock options. Should I exercise? When should I sell them? Capital gains come into play, taxes come into play. You start planning for a family. Another key thing too that I like to tell people, when you look at taxes, don't focus only on the tax preparation of the return itself, because if you're working with a professional throughout the year, one of the things that you can do is plan ahead. Like you mentioned, James, before, you can be strategic about things. So there might be situations like the pandemic created a lot of opportunities for people where they might have lost some income because they lost their job, but in reality, there were some opportunities that were there, like selling some real estate and paying 0% capital gains tax because they were under a certain amount of income, right? So if you're doing that on your own, you might miss out on an opportunity because there are things that you cannot undo or go back in time and do, right? So part of the importance of working with a professional is also not just doing the tax preparation, but doing tax planning throughout the year.
Got it. Very interesting. And kind of the common theme, if I can pull it, is that, even if you do have the expertise to do this, maybe your time is better spent elsewhere, sourcing homes, building up your portfolio, again, a cost benefit analysis. A really awesome answer too. I guess, finally, I think we've been touching on this question a little bit throughout the webinar. Obviously real estate is a very attractive investment. The fact that you do collect rental income, which pays off your expenses, puts cash in your pocket, the home appreciates or goes up in value over time. I guess, what other qualities of real estate make it attractive, do you think? And with that in mind, how would you typically recommend someone structure their portfolio to include real estate?
Yeah, so real estate is pretty unique in the way that one of the things that it's tangible, right? It's something that you can touch. It actually exists. There's a structure there, as opposed to, say, stocks, right? You usually just see them on your statement, right? Like, you don't get an actual stock in the mail.
Yeah.
You just own them on a statement. It's just an entry. Real estate, there's something physical there. Now, there are some advantages that you can use from real estate, because not only, say, if you're using it as rental property, not only are you getting the rental income, you're also having property appreciation over time, right? There are situations where it goes down just like any other asset, but historically, the asset price tends to go up, right? So that could be a great strategy for people to start building a portfolio of assets based off of one property. So very commonly, I've worked with clients in the past where they initially bought their primary residence, and I alluded to this in the past. They are then able to take that asset and take advantage of the fact that it went up over a couple of years. Some have refinanced their mortgage, taken advantage of that the value went up, taken some cash out, used that to buy their first rental home, or they might have turned that into a rental, take the cash out to put a down payment on the new one. So now you're using leverage, right? You're using that one single asset that grew, that you're taking advantage of tax-wise throughout the years, but you also then get to take advantage of the asset appreciation. So when it comes to allocating in your portfolio, I'm a big believer in not having all your eggs in one basket, right? So you shouldn't be 100% invested in stocks, bonds, your company stock, nothing, right? So you should have a blend of investments that you have in your overall portfolio. So when you look at your portfolio, look at everything, not just your money that's invested. You look at your real estate assets, your 401k, your IRAs, anything that you're investing in general, right? So if you look at your overall asset, then you want to say, well, how much should I have in real estate? If you look into that, one thing that you just got to keep in mind is that you should have enough money saved up for unforeseen expenses. So on the personal side, usually I tell people to have at a very minimum anywhere between 3 to 6 months worth of expenses. When you have real estate, if you can try to do that as well, because things happen. And again, the pandemic was a year that has brought that to light. A lot of people lost their jobs. So if you're a real estate owner, maybe your tenant wasn't able to pay you for 3 months, right? Or you might have lost some tenants. So you want to make sure that you have enough money to carry that property as you navigate these changes, right? So it's a great asset to have in terms of your overall portfolio, just make sure that you have enough liquidity. So ensure that you have your 6 months reserves in your personal life first, that you're taking advantage of your employer match, if there is any, in your 401k. And then if you have already enough money accumulated for your short-term goals and you have everything else set up and you have extra income and you want to venture out into real estate, then that could be a great addition to your overall portfolio as well.
Really, really well said. And obviously, totally agree. And I think what I can pull from this question is it's all about risk management, not only just across your portfolio, but then across each asset that you have within your portfolio. That was awesome. And it looks like we have a couple of questions coming in from people. So if you don't mind, I think I can read them off. And then if you want to throw me your answer.
That'd be great.
Cool.
And one more thing before we get to them, James, I wanted to mention, I think we touched on it a little bit, but real estate can also be used as a hedge for inflation, right? So a lot of people hear that. And so let me tell you a little bit about that. Inflation is just the prices of things going up over time, right? So you hear that word inflation. I was an economics major, so I actually love this stuff. I'll try not to bore you too much. But ultimately, when you think about the things that you buy on a day-to-day basis, you don't feel that they go up every day, right? When you look at the prices of gas, a gallon of milk, things like that. But when you look at them over time, things start going up in cost over time significantly the more time passes. So one good thing about real estate is that traditionally it follows what inflation is doing. When things are going up, if you own real estate, typically inflation helps the value of that property go up. If you are a landlord, then inflation usually would help you drive up the cost of that lease that you're charging as well to your tenants, right? So if you're a renter now, right, you notice that your rent goes up over time. Probably every time you renew it, there's like a $25 add-on, right? So imagine being on the other side of that.
Yeah, no, absolutely. And it's interesting too. I mean, what I would kind of highlight from that, or what speaks to it, the fact that real estate is a hedge against inflation because its value does increase faster than the value of money increases, is because real estate is so safe. If you look at the 30, 40, 50-year trend of real estate in the US, it is typically up and to the right, which is obviously why we really like it here at Doorbest. And cool. Let's see. We do have, I have a really good question here. This is from Sean. Sean said, question regarding taxes for real estate investors. I have a W-2 job and makes $150K. I think actually you might have answered this earlier in the chat. From what I've seen and been told, due to that I can't write off real estate losses from my real estate investments. For example, if I'm invested as an LP in an apartment complex and the end of the year get a K1 showing a loss, that doesn't affect or reduce my overall tax obligation. Is there a real estate investment where I can take advantage of real estate losses and depreciation if I have a high-paying W-2 job?
Yeah, Sean, thank you for the questions. So unfortunately, you have a good problem, right? You're making over 150,000. So congrats on that. But the way the IRS rules are, because of the passive activity limitations, there are those income restrictions. So if you make under 100,000, you can deduct up to $25,000 between 100 and 150. A portion of that, and over 150, you cannot. Right now, the good news is that if you are in that situation and happen to have a loss, it means that you did not pay any taxes on your rental income. Right. The bonus to that would have been to also write off the loss. Now, what you get to do is those losses get accumulated. So again, another reason why you want to work with a professional, because if they do it right, what that means is that every year they accumulate. So you carry forward, if you would, to other years in the future. Eventually, those losses that accumulate year over year, you get to take advantage of when you sell that piece of property. Now you say, okay, I have X profit. However, I did have all these losses that I was not able to take over time. And now I can deduct the year of the sale. Now, another thing that you can do is if you were considered a real estate investment professional. That's the only other way where you can take advantage of the losses as I earn it. But you couldn't be a W-2 employee, because one of the rules is that the majority of your time would have to be spent in the real estate business. So as a W-2 employee, if that's the majority of your time, you're subject to those limitations, unfortunately.
Got it. And I think you are reading everybody's minds, because the next question addresses that exactly. I'll read it off and I'll hand it over to you. It says, quote, "Thank you for this. Another tax-related question. If there's time, benefits, or thoughts to consider in cross-qualifying as a real estate professional. For those of us who still have full-time jobs, but maybe thinking about dropping down into part-time or relying more on passive income in the future. This was from James.
Got it. Okay. Yeah. So it touches on a little bit of what we're talking about. So that could be a good strategy, because if you are considered a professional real estate investor, then you could write off more than the $25,000 against other losses, any other income that you have. So as a W-2 employee, you're subject to those limitations. Now, this is again where you want to confirm with your CPA, tax attorney, et cetera, because the IRS is very specific as to what is considered an investment professional. So there are some guidelines. You have to spend more than half of your time in it, a minimum of 750 hours, and other rules. But ultimately, yeah, if you're working your way towards building a real estate portfolio, and eventually that's what you're going to do, is just like manage your properties full time, then yeah, you're able to take advantage of much more in terms of taxes, which is why you hear a lot in the news where you hear like these big billionaires that pay zero in taxes, because that's one way that you can do it, right? Just have a huge real estate portfolio. The average person usually doesn't get to do that. But if you have such a big portfolio, you can just write off a whole bunch of losses and in essence pay very little tax as a result, right? So, that's one of the tricks that the rich have up their sleeve, but it's there in the tax code for you to take advantage of. Yeah.
Very, very interesting. Okay, and then looks like last question here. This was from Rashid. Standard deductions are $12,400 approximately. My individual deductions have to be more than that in order for it to be worth it to deduct, correct? Otherwise, there wouldn't be any tax benefit for me. Can you clarify this?
Yes, that is correct. So at the end of the day, when you do your taxes, you have two options. You either take the standard deduction, which was $12,400 for a single, $24,800 for a married couple filing jointly in 2020. They usually get adjusted for inflation. So there you go with inflation again. This year for 2021 is $12,550 for single and $25,100 for a couple that's married filing jointly. So at the end of the day, the IRS always lets you take whatever is more advantageous for you. So if you're a W-2 employee and you don't have any big write-offs, you don't own any home, you're not sending a lot of money to charity, you don't have huge medical expenses, things like that, you're very likely going to end up taking the standard deduction. If you are in a place where you have, say, a home and you have mortgage interest, property taxes, you pay state and local tax, charity, deductions from your medical expenses over 7.5% of your income, you want to add those up, and that may end up being a bigger number. Now, just because you own a primary residence doesn't always mean you get a tax deduction. A lot of people are a little bit in shock when I tell them this, because the standard deduction numbers are so high. So, for example, a couple that's married filing jointly is, $25,100 you would have to have. So if your mortgage interest was $12,000 and your property taxes are $8,000, you only have $20,000. So you still can't really itemize. You just take the standard deduction. So yet another reason to work with a professional to make sure that you're taking advantage of all the available deductions out there that you can take. But you are correct. At the end of the day, it's either standard or itemized. And if the itemized are higher, then you go with the higher number, which is more beneficial tax-wise for you.
Interesting. Okay. Very cool. All right. Looks like we have a couple of questions. Will this recording be available post-session? Yes, I can answer that one. It absolutely will. I also have a question from a Dion. They say, I know we went over this, but would you mind clarifying the repairs versus improvement deduction? Again, what would be considered repairs? What would be considered improvement? I'll kick that back over to you.
Yes, very good question. So think of an improvement as anything that may add value to the property. That's a short way of thinking about it. A new roof would add value to the house, heating, ventilation, air conditioning, things of that sort, right? So a repair is something that is usually a one-time thing, a quick fix. A doorknob broken, a door, you needed to replace a toilet seat, something like that, hole in the wall, little things like that. Those are repairs. Those things you could just write off as an expense the year off on your Schedule E. If you have a capital improvement, which is another thing that I've seen people make as a mistake, where they just like put a new heating, ventilation, air conditioning, just like wrote off the entire amount. the IRS would definitely frown upon that. You're supposed to do that in its own depreciation schedule, just like you do with the property, and just take that small deduction over a period of time. So in short, think about improvements as something that would add value to the property. So you know that if you replace a hole in the wall, it's not going to add value in terms of like resale, right? So that might be just, just a rule of thumb, quick way of thinking about it. You want to confirm with your accountant.
Got it. That sounds good. And that's awesome. Well, Louis, thank you so much for joining us. This was a blast chatting with you about tax. We got into some pretty technical stuff, but you laid it out very clearly and articulately, and this was awesome to hear. And I learned a lot as well, and I hope everybody did too. I wanted to finish it off by passing it over to you one last time. Is there anybody that people can like learn more about yourself and your company? If you want to give your Twitter and Instagram handle. I know there's a lot of people who ask us for advice, and yeah, I'd love to just kick it over to you and how people can learn more.
Oh, thank you, James. I appreciate it. Yes, my website is buildabetterfinancialfuture.com. I also have a podcast called On My Way to Wealth. I have a website, onmywaytowealth.com, or you can listen to it on iTunes, Spotify, all the major podcasting platforms. Twitter handle and Instagram handle are the same. It's my name, Luis_F as in Frank _Rosa. And also, yeah, I'm on LinkedIn, but it's probably a little harder to find, right? So Twitter, Instagram, Luis_F_Rosa, buildabetterfinancialfuture.com, onmywaytowealth.com. I actually offer a complimentary consultation for those that are listening. So if you want to schedule some time with me, you have some questions that maybe you didn't get to here in the webinar, I'll be happy to just chat with you for a bit and see if I can help you in any way. So just go to buildabetterfinancialfuture.com, click on schedule a call, and then choose whether you want a phone call or a video chat, and we can do a Zoom on a one-on-one.
That's awesome. Okay, well, thank you so much again for joining us, and this was a pleasure and an absolute blast. And take care, and I'll see you guys later. Thanks as well to everybody else who joined us. This is always fun. We're going to be sending out more information after this, and stay tuned for the next DoorBest podcast. Other than that, take care, and thank you so much, Louis.
Thank you.